Hello everybody, this is Sungko, the Korean bro. Today is 2023, December 12th. Let's see what articles we have tonight, okay? Hmm. Two stock split, artificial intelligence stocks by hand over fist. Nvidia might split its stock, but it's a buy even if it doesn't. Okay, okay, Nvidia's stock price is high enough to consider a split. For me, a stock split is no reason to buy a stock. However, at $462 per share, Nvidia's management might want to consider splitting its stock. Yo, Nvidia is on the leading edge of AI technology while earning phenomenal profits and trading at a relatively fair valuation. A stock split could bring added attention to a stock already getting a lot of attention. The more affordable per share price after splitting could attract more retail investors who missed out on the stock when shares were priced at more reasonable levels before its big 2023 run up. Nvidia is showing the benefits of investing in AI technology. Revenue increased 102% to 6% year over year in its two most recent quarters, respectively. The revenue growth brought with it improved profitability. Nvidia's operating income jumped to $6.8 billion and $10.4 billion in the two quarters. Those figures were up from $499 million and $61 million in the comparative quarters the year prior. The growth in revenue and profit has been explosive for Nvidia thanks to AI. Meanwhile, Nvidia stock is trading at a forward price to earnings ratio of 23.6, a valuation I expect to pay for a company with less impressive performance and prospects. Nvidia's front row position in the growth of the AI market, premium profitability, and reasonable valuation make it one stock investors can buy with enthusiasm in December. Okay, next. Global E Online. Hmm. Warren Buffett has long recommended S&P 500 ETF for investors. The right ETF can help minimize risk while still earning a lot of money over time. However, there is one significant downside to consider before you buy. Long track record of success, strong and healthy stocks, building wealth with the S&P 500. Despite being a relatively safe and simple investment, as the S&P 500 ETF packs a punch. Historically, the market itself has earned on average rate of return of around 10% per year, which means that the annual highs and lows have averaged out to roughly 10% per year over several decades. If you are investing, say, $200 per month in S&P 500 ETF, earning a 10% average annual return, here's approximately how much you could accumulate over time, depending on how many years you invest. The more time you have to let your money grow, the more you can potentially earn over time. Again, the S&P 500 ETF is a long-term investment. While you may see a significant ups and downs in the near term, it's incredibly consistent over decades. While the S&P 500 ETF has plenty of advantages, there's one significant downside to consider. You can't beat the market. This type of investment is designed to follow the market, so it's impossible for it to earn above average returns. If you're looking to maximize your earnings in the stock market, investing in individual stocks may be a better position. Okay, Tesla's growth is slow and its margins are shrinking. Investors will need to see rapid sales and earnings gains in 2024. However, the state valuation is a serious headwind. Quantum Scape. Hmm. Hmm. Okay, let's see this one. Will Amazon stock be in 3 years? The stock will look cheap even after its soaring 2023 rally. Amazon's web services is boosting margins and accelerating growth. Cloud services have already started to eclipse Amazon's massive e-commerce business. 3 years ago, Amazon looked invincible. The stock was setting record highs in late 2020 as investors predicted that the soaring growth rates from the pandemic would continue, even as costs remained low. Both forecasts turned out to be flat wrong. Inflation pressured consumer spending while driving costs higher over the last few years. Instead, rising interest rates amplify these challenges and help keep Amazon stock below those record highs. Both forecasts turned out to be flat wrong. Inflation pressured consumer spending while driving costs higher over the last few years. Instead, rising interest rates amplify these challenges, mm, help keep Amazon stock below those record highs. The next few years could be just as volatile for e-commerce giants business, but there's plenty that investors don't know about the future. Yet several big trends promise to shape Amazon's wider results from here, along with its stock returns. Amazon is a more service-oriented business now. It's safe to assume that Amazon will be much more of a service business in a few years than it is today. This segment, home to things like the AWS platform, already accounts for a majority of the sales profit footprint, responsible for 55% of sales in the first 9 months of 2023. Well, it's growing much faster too, at 17% compared to a 4% uptick in product sales. I mean, that's great news when it comes to stability of the business. Service sales comes from areas like Prime subscriptions and AWS country, which aren't nearly as volatile as day-to-day product sales. The more that Amazon can mature into software as service stock, the more investors can count on increased clarity around annual sales and earnings trends. High profits. Amazon is slowly making its way back toward the 6% profit margin record it set a few years ago. That's better than traditional retailer rivals like Costco Wholesale can match, but is far below the over 40% profit rate that growth stock investors can get from a company like Microsoft. There's a good chance that Amazon's margins will reach double digits over the next few years, though operating income is already soaring compared to last year, for example. The company generated $24 billion in profits in the past 3 quarters, up from $10 billion a year earlier. Management projects profits as high as $11 billion in the holiday quarter two, compared to $3 billion in late 2022. Amazon is targeting more balance between growth and profits today. And this approach should continue improving its finances over the next several years. The X factor. One big benefit of owning Amazon stock is that there's always the potential for major tech-based growth to go along with its mature business lines. The company is investing heavily in artificial intelligence, for example, which has made its way into products as varied as its smart speakers and e-commerce services platform. The technology is boosting the value of Amazon's products in the same way that it is for Adobe's and Microsoft's portfolios. The Wall Street seems to be discounting the growth potential for Amazon. Shares are valued at less than 3 times annual sales compared to closer to 13 times for both of these software focused peers. Investors can reasonably expect this valuation gap to shrink over the next few years as Amazon becomes more of a service business. A strong profit margin and cash flow production boost overall returns. Look for the stock to likely outpace the market in that optimistic scenario. Most of these names, okay, let's see. Is a winner in the two high growth market, e-commerce and cloud computing. The company's leadership in those areas is set to last thanks to its investment in innovation. For example, in e-commerce, it's worked to make delivery faster and more efficient and to add benefits to its Prime subscription services. In cloud computing, it's invested in the high growth area of artificial intelligence to serve clients eager to add AI to their latest projects. The market genre also has a solid track record of growth, and after recent tough spell due to the weak economic environment, Amazon showed it could manage difficult times too. In fact, Amazon chose this time to improve its cost structure, and the efforts are bearing fruit. In the most recent quarter, the company reported gains across various financial metrics, from net sales to free cash flow. Considering these elements, they have 54 times forward earnings estimate. Big time growth stock Amazon looks cheap compared to its forward PE ratio of around 90 at the close of 2021. Amazon has a huge and growing service business. Look for profit margins to reach toward double digits in the coming years. Amazon has a huge and growing service business. Look for profit margins to reach toward double digits in the coming years. It isn't easy for a massive business to grow quickly, but that's exactly what Amazon is doing right now. Revenue jumped 11% over the past 9 months to $4 or $5 billion, uh, tacking on an additional $40 billion to its sales footprint. Growth investors should be even more pleased about where those gains are coming from. Amazon's product sales are rebounding nicely, essentially marking an end to the growth hangover that followed the pandemic demand spike. The company sold over 1 billion items to kick off the hottest shopping season, suggesting excellent customer traffic heading into 2024. But the service segment is a bigger growth driver and promises to power the business forward from here. It accounts for about 55% of sales now and grew at a 17% rate through the first 3 quarters of the year. It's a big push for the business to have more than one huge global industry to target for growth. Shifting priorities. Amazon has been famously stubborn about choosing to prioritize long-term growth over profits. However, the business maturity and the tilt toward service sales are helping to change that trend, which is great news for shareholders looking for a better balance between earnings and growth. While the company still invested heavily in initiatives like artificial intelligence and faster e-commerce delivery speeds, Amazon more than doubled its operating profit to $24 billion in recent months. The company's cash flow trends point to even bigger earnings growth ahead. Free cash flow was $21 billion over the past year, compared to $20 billion outflow in the same period a year earlier. While Amazon will likely continue spending heavily in areas like its shipping and data networks, the business has demonstrated that it can be financially prudent at the same time. Fill your shopping cart. Amazon stock doesn't look too expensive following its rally this year. Shares are priced at 2.7 times annual sales in early December to mark a record valuation for 2023. Sure, however, the valuation is down from the nearly 5 times annual sales that the investors were paying for the growth stock in late 2020. You'll pay closer to 12 times revenue to own Microsoft, for example. Doesn't look too expensive following its rally this year. Shares are priced at 2.7 times annual sales in early December. To mark a record valuation for 2023, sure. However, the valuation is down from nearly 5 times annual sales that investors were paying for the growth stock in late 2020. You'll pay closer to 12 times revenue to own Microsoft, for example. Microsoft is far more profitable, with operating income landing at 43% of sales compared to Amazon's 5% rate. As services become a bigger part of this business, look for Amazon's margins to head toward double digits, likely pushing shareholder returns higher in the process through 2024 and beyond. Like 4 companies you want. Okay, let's see. Here, breaking down Amazon's revenue. Amazon has made its shares of millionaires. In fact, it's made its shares of billionaires. When I think of companies that can keep making millionaires in the future, it tops my list. Let's start with the obvious. Amazon is already a massive company. It has a market cap of $1.5 trillion, making it the fourth largest American company, trailing only Apple, Microsoft, Alphabet, the parent company of Google. In truth, Amazon is really 4 companies in one. Consider the different ways it makes money. What finance Topco its revenue streams? Amazon has 4 big ones. Retail, this includes the company's sprawling e-commerce business, physical stores, and third-party seller services. subscription services. This includes the company's flagship Amazon Prime, along with Prime Music, Prime Video, Audible, and Amazon Gaming. Amazon Web Services. This includes the company's fast-growing, high-margin cloud services business, the biggest cloud services provider in the world. Company's fast-growing, high-margin cloud services business, the biggest cloud services provider in the world. This includes revenue generated by selling ads on the Amazon apps and website, as well as audio and video ads and streaming content. Revenue generated by selling ads on the Amazon app and website, as well as audio and video ads on the streaming content. Company's fast-growing, high-margin cloud services business, the biggest cloud service provider in the world. Crucially, the fastest-growing segments for Amazon are also the most profitable ones. AWS is growing at 13% year-over-year, subscription services at 15%, and advertising is soaring by 26%. Without doubt, Amazon's enormous e-commerce business is central to its strategy. However, its three other business segments increasingly drive revenue growth, earnings, and free cash flow. And that's great news for investors because it allows the company to ride massive secular growth trends in digital advertising, cloud services, and media streaming. In other words, Amazon has set the stage for decades of growth to come, growth that could lead to lots of millionaires. Okay. Hmm. Okay. Alphabet here. Deep learning alphabet. Okay, Alphabet has a current market cap of $1.65 trillion, making it the most likely candidate to join the $2 trillion club in 2024. To surpass this benchmark, the stock will need to rise just 21% from Tuesday's closing price. Alphabet stock has increased by 20% annually. On average, over the past 5 years, even when accounting for the worst downturn in more than a decade, so it isn't too much of a stretch. It's also worth pointing out that this won't be the first time Alphabet has joined this exclusive fraternity, having originally surpassed this benchmark in November 2021, just weeks before the onset of the bear market. The biggest potential driver of Alphabet stock over the coming year isn't AI, but digital advertising. Google is the global leader in digital advertising, controlling roughly 30% of the worldwide market, according to online marketing trade publication Digday. The ongoing rebound in advertising will boost Alphabet's fortunes as AdTech is responsible for the lion's share of the company's revenue. Additionally, worldwide digital ad spending is expected to grow from $531 billion in 2022 to $1.5 trillion by 2030, growing 14% annually. According to research firm Research and Markets, a return to historical marketing ad spend alone could be enough to catapult Alphabet's market cap above $2 trillion. Let's not forget AI, as Alphabet has been working feverishly to stake its climb. Thanks to recent advancements in generative AI, the large language model that formed the foundation for these next generation algorithms can cost hundreds of millions of dollars to produce. Many experts suggest that well-heeled cloud infrastructure providers are in the best position to develop and provide these AI services to their customers, and Google Cloud is among the largest. Finally, the trifecta of AI, cloud computing, and digital advertising should give Alphabet enough traction to regain its place in the $2 trillion club. Alphabet recently released its new Google Gemini AI model. Procore is introducing a copilot to improve efficiency, Accenture be crucial in the implementation of AI. Alphabet is likely the most familiar company on this list, as it's the parent company of Google, a company that's right in the middle of the AI race. Recently announced its Gemini generative AI model, which outperforms many of its competitors. With Google Gemini having such an advantage in many areas, it will become one of the top models developers base their generative AI applications on. Beyond that, Alphabet is still highly exposed to the advertising industry, with 78% of its revenue coming from this focus. You know, this is critical as Alphabet won't be a flop as an investment, even if it doesn't have AI doesn't have as much of an effect as many people believe. Alphabet is also executing at a higher level, with earnings per share rising from a 1.6 to 1.555 in quarter three. Despite strong AI offering in recent results, Alphabet only trades at 20 times 2024 earnings, which isn't a bad price to pay considering the upside that could be ahead of Alphabet. Whether you are an AI investor or not, Alphabet looks like a solid buy in December and beyond. Okay, this is it for today, and see you and have a good night, everybody. Bye bye.